Good morning, dear friends. In our last lecture, we were doing the determination of annual value under the topic of income from house property. I just want to recapitulate because this is a very important concept and it will going to form the basis for your valuation of the income under this head because it provides the basis. We learned that how the annual value is to be determined in respect of any house property. I'll try to explain this thing with an example. Before I just come to the example, I just want you to recapitulate as what we did in our last lecture. The first step for the purpose of determination of annual value is, step 1 is, you just have the municipal value of the house property and you have the fair rental value, means municipal value, fair rental value. You compare this both this municipal value and fair rental value of the house property and take the higher of the two. If municipal value is higher as compared to the fair rental value, take the municipal value. If the municipal value is higher than, if the fair rental value is higher than the municipal value, then take the fair rental value of the house property. So, in the first step, we'll have to take the higher of these two values. That is our first step. Second step is step number 2. Step number 2 is, now you have got one value which is higher of it. Under step number 2, you compare this value with the standard value. Standard value is standard rent of the house property. It means now this value, whatever value it comes, you just compare this value with the standard value of the house property and you take lower of these two. This is the value which will be under step number 2. This value, whatever value it comes, it is also called the expected rent of the house. You can say expected rent. This is the expected rental value. So the expected rental value can either be equal to the standard value, but in no case it would be more than the standard value. Because in the second step, what we are doing, we are just taking lower of these two values. Means in the first case, we did take the higher of the two values. The higher of the two values were municipal value and the fair rental value. In the second step, we will compare the value which has been determined under step number 1 with the standard value of the property, and we will just say lower of these two. So lower of the two will form the basis for our calculation under step number 3. Now, the step number 3, whatever value you just receive under step number 2 means value at step number 2 minus the loss of rental value due to vacancy. Loss of rental value due to vacancy of house property means your house might be lying vacant for some portion of time during the previous year. So if that particular loss of rental is there, you will have to deduct this value from the value which has been arrived under step number 2. So this you just did it. Now this is the value which will be under step number 3. The last step is step number 4. In this case, whatever value comes here, it means whatever figure, whatever value comes here, you just compare this value with the actual rent received or receivable by the house property and you take higher of these two. It means whatever value is there, for example, the value under this step number 3 is say 30,000, is rupees 30,000. I am just taking the annual value. Assume that the value which has been calculated under step number 3 after having taken into account the loss of value due to vacancy is rupees 30,000 and the actual rent received by the owner of the house is say 37,000. We will take higher of these two. It means higher would be taken in the fourth step, and this value, the higher of this value, would be taken for the purpose of determination of annual value, and the value which comes under step number 4 would be called the gross annual value. What it would be called? That would be the gross annual value. I think the steps are quite clear, but even then we'll just try to understand this particular concept with an example, and we'll just try to solve the question for understanding this concept. This is the example where the different values are given. Along with that, the municipal taxes are also paid. Just read the question carefully. The first item is municipal value, which is 1100 per month. Fair rental value is 1500 per month. Standard rent of the house is 1300 per month. Actual rent is 1500 per month, and the municipal taxes paid are 4000 per year. So these are the values which have been given in respect of a particular house property. That is for the purpose of we have just taken this example for the purpose of explaining you the determination of annual value, how we calculate the annual value of the property. So in this case, the first step would be, which I just told you, the step number 1 would be you just compare the municipal value and the fair rental value. So municipal value is 1100 rupees per month. This is the municipal value, and the fair rental value is 1500 rupees per month. As I just told you earlier also, in the first step we will have to take higher of these two values. So the value higher is 1500. So step number 2 would be higher of this value 1500, that would be taken, and this value 1500 value, we will just compare this value with the standard rent. What is the standard rent? The standard rent of the house is 1300 per month. So again, we will just compare this value with the standard rent, and we will take lower of these two. So the lower of these two is 1300. So 1300 per month would be taken under the step number 2, and this 1300 per month we can also call it as expected rent of the house. This value is also called the expected rent of the house. So under step number 3 would be, we will just take this value, because this value will provide the feedback for the value for step number 3. This value, from this value we will deduct the loss of rent due to vacancy. Since no such information has been given in the questions, so we will just take that there is no loss of rent due to vacancy. So the same value which was there in step number 2 shall be same under step number 3 also. So 1300 per month would be the value under step number 3. Now the last step is step number 4. You just compare this value with the actual rent received or receivable by the owner of the house. The actual rent of the house is 1500 rupees per month. This is 1300 rupees per month. So I told you earlier, in step number 4 we will have to take higher of these two values, and the higher of these two values would be 1500 rupees per month. So this 1500 rupees per month, if I just multiply it by 12, the annual value of this house would be equal to 18,000. This is also called the gross annual value of the house. So this is 18,000. This is the gross annual value of the house, and from the gross annual value of the house we shall deduct the municipal taxes paid, because only taxes paid, actually paid, they are to be deducted. You please remember it. If any taxes are due but they haven't been paid, then these will not form the basis for deduction. It means no deduction would be allowed if the taxes are due but which have not been paid. So here the gross annual value is equal to 18,000 minus municipal taxes 4,000. So net annual value of the house property would be rupees 14,000 per year. This is the way we can calculate, we can determine the annual value of the property. The method is same for respect of all the properties. Means this is the way we can calculate the value of house property. Again, we can understand this with another example where some more information is there. Here, just look at the example. Mr. Bajaj is the owner of a house having the following particulars. Compute the net asset value of the house. Here is talking about the net annual value of the house. The municipal value is 2,40,000. These figures are given for the whole year. So 2,40,000 per annum, that is the municipal value of a particular house which Mr. Bajaj is owning. The fair rental value of the house is 2,60,000. The standard rent is 2,10,000 and monthly rent is 25,000 rupees per month. So this is the last figure, monthly rent, that is given in terms of months. Apart from that, municipal taxes are there 25,000, but this 25,000 they are due, but they have not been paid. The next is the house remained vacant for a period of 3 months. So due to that, the loss of rent due to that vacancy was 75,000. It means in our earlier example, these two figures were not there. Now we have just taken these two more information. So based on that, we can calculate the annual value of the property just by following the same steps which we just learned in our earlier example. So in the first step, what we will do? First of all, we will compare the municipal value and the fair rental value, and we will just take higher of these two. So under step number 1, higher of municipal value and fair rental value. Higher is 2,60,000 amount in rupees. So we will just take 2,60,000 because municipal value is 2,40,000, fair rental value is 2,60,000. So under step number 1, we will be just taking the higher of these two. Now step number 2 would be compare this value with the standard rent, and we will just take lower of these two values. It means here this value would be compared with the standard rent, and the standard rent of the house is 2,10,000. So based on that, we will just take lower of these two. So under step number 2, lower of standard rent and the value at step number 1. So we will take 2,10,000 under step number 2. Now third step is, from this value reduce the loss of rent due to vacancy. This value is 2,10,000 and the loss of rent due to vacancy is how much? 75,000, because the house remained vacant for 3 months. So the loss of rent is 75,000 rupees per year. The resultant value would be 1,35,000. So this is the value which would be taken under step number 3. Now the last step is that the final step is you compare this value with the actual rent received or receivable by the owner. This value is 1,35,000, whereas the actual rent received by the owner is for 9 months, because for 3 months he did not receive any rent due to its vacancy. So he just received the rent at the rate of 25,000 for 9 months. So the value would be 2,25,000. That is the actual amount of rent which he has received. So we'll just compare it and we'll just take higher of these two. Please, this is very important step. Higher of these two values would be taken as your gross annual value. This would be called the gross annual value. So my gross annual value would be 2,25,000. My gross annual value would not be 1,35,000, which has been determined under step number 3, because while step number 4 will just take higher of these two values. So the higher of the two values would be 2,25,000. This is my gross annual value, and from this gross annual value we shall deduct the municipal taxes which have been paid by the owner of the house. Here in this case, the municipal taxes are to the tune of 25,000 rupees per annum, but he has not actually paid. These are just due. So since these haven't been paid, no deduction on this account would be made from this gross annual value, and the same gross annual value shall be reckoned as the net annual value of the property. I think with this example and with the earlier example, the things would be quite clear. I think that would be crystal clear to you. Thank you very much.